Good morning. We are on our Friday supplemental session on Chapter 3. We have a lot going on in this chapter, a lot of extra exercises we're going to do, so we'll get started in just a minute. Just a reminder about what's due this week. We have Chapter 3 homework, the exam info quiz, and the practice exam 1 is due Wednesday, September 24th, so you have until you take the exam to take the practice exam quiz. Section 3 also has a regular quiz in addition to the exam info quiz. Exam is next week, Monday through Wednesday. We do not have class next week, so there will be no recorded sessions either. Your job next week is to take the exam. So, Chapter 3. Wanted to point out that Exhibit 3.7 is a nice summary of all the different kinds of adjusting entries we can have. And how this works is it tells you what the journal entry is going to look like for the adjusting entry. For example, a prepaid expense will debit an expense and credit the asset. Depreciation will debit expense, credit contra asset, etc. So that's a good exhibit when you're looking for things to write down. And we'll just get started on the homework because we have several exercises that if you need extra assistance, we're going to walk through them. So exercise 3-10, we have a travel service borrowed $75,000 on October 1st by signing a note payable. The interest expense for each month on this note is $312. They computed it for us, and the loan agreement requires perfect travel to pay interest on December 31st. So our first requirement is to make perfect travel's adjusting entry to accrue monthly interest expense at October 31st, at November 30th, and December 31st. So we're making 3 adjusting entries. The first one, October 31st, we want to accrue interest. We want to recognize that we've had this note for a month, so we've incurred the interest on it for a month, but we're not going to pay the interest until later. So we're going to show that we have interest expense by debiting interest expense, and we're going to credit interest payable. Now this explanation line, or the memo line, is not meant to be complicated. It's simply saying, what did we do here? And this is just to accrue interest expense for October. Now for November, I don't know that I'd write it down. I would just write November. It's not November 31st, that's November 30th. And it's the same exact entry as October because another month went by and we owe interest, additional interest. So we're going to debit interest expense, credit interest payable. When we accrue interest, it's always going to look like this. We're going to debit interest expense, credit interest payable. Okay. Now, December 31st, we're going to accrue interest again. So again, you don't necessarily need to write all 3 of these down. They're going to look exactly the same each month because we're accruing additional interest each month. Next, requirement 2 says to post all 3 entries to the interest payable account. We don't need to drop a balance in. So what we're going to do is a T account, interest payable. It's a liability. So we're going to see on October 31st, it's driving me nuts, November 30th and December 31st, $312 each. Those were the credits to interest payable, and then our balance at December 31st is $936, which is $312 plus $312 plus $312. And then our final requirement here is to record the payment of 3 months interest at December 31st. So when we pay the 3 months interest, what we'll be doing is we're paying the $936. That's the 312 times 3 months. So we're going to credit cash, and we know we're reducing cash, so it's a credit. And then we're debiting interest payable. That's a liability, and we're reducing the liability because we're paying what we owe. And that's it on that exercise. That's all that's involved there. They really do a lot of the heavy lifting for us by computing the interest amount each month. Now, the next exercise we're going to do, I've actually gotten some questions about it via email, so this will be a good one to walk through. So the next one we're going to do is exercise 3-20A. Exercise 3-20A says an accountant made the following adjusting entries. So we're given 6 different adjusting entries. We have to, number 1, journalize the adjusting entries. And really that's just saying let's make the adjusting entries for each of those 6 situations. And then number 2, let's assume we didn't make the adjustments. What's the overall impact of that error? So we're going to start with requirement 1 to journalize the adjusting entries. So we're going to start with the first entry. And that first entry is prepaid insurance has a beginning balance of $600. Payments for insurance during the year are $2,400, and then the ending balance of prepaid insurance should be $700. So what we're saying is we started with $600, we bought $2,400 more. So we have $3,000 of prepaid insurance, but we want our balance to only be $700. So what we're going to do there, we started with $600, we added $2,400, that's $3,000 minus the $700 that we have left. We used up $2,300, and that's our insurance expense. So the adjusting entry for entry A is going to be the debit insurance expense for $2,300, credit prepaid insurance. If we have an entry for an adjusting entry for insurance, it's always going to be the debit insurance expense, credit prepaid insurance. Now this one's a little bit different from the one we did in class because we had payments for insurance during the period. So what we're saying is we started with $600, we bought more insurance for $2,400. So we had a total of $3,000 of insurance either that we started with or that we purchased. We had this $3,000, but at the end of the period we only have $700 left. So to get from the $3,000 down to the $700, we had to have used $2,300 of our insurance. So that is our first entry. That's the first adjusting entry for insurance. Next, we're going to go on to entry B. Entry B, interest revenue accrued $2,600. Now what's happening here is they're saying that we've earned interest revenue, but we have not received it yet. So to accrue revenue, we're going to debit the interest receivable, which is an asset, for the $2,600. And then we're going to credit interest revenue for $2,600. When we credit a revenue, we're increasing revenue. So we're going to debit interest receivable, credit interest revenue, and that's the adjusting entry for B. Good morning to those of you who have joined us since we started. And I don't have the explanations on these journal entries, but this one, for example, would be to accrue interest revenue. Next up, we have entry C. Entry C tells us our unearned service revenue beginning balance at the beginning of the period was $1,700. At the end of the period, it should be $500. So basically, we've earned that difference between there. We started with $1,700 that we had unearned, which is a liability, and then we ended with only $500 unearned, so we had to have earned the difference between those two. So what we're going to see is that $1,200 difference. We're going to debit unearned service revenue. We're reducing our liability. And we're going to credit service revenue because we've earned that $1,200. So we want to increase service revenue. So what we're doing in this adjusting entry is reducing the liability and increasing revenue because we've earned the amount of that balance has fallen. Our next entry, depreciation. Depreciation is a nice one, and the reason I say depreciation is a nice one is because the journal entry always looks the same. In this case, we're being told how much the depreciation is. When we see depreciation and we need an adjusting entry for depreciation, we just go to our sheet for the depreciation entry we've written down. It's always going to debit depreciation expense and credit accumulated depreciation. The adjusting entry for depreciation is always to debit depreciation expense, credit accumulated depreciation. And again, if we were writing an explanation line, we would just say depreciation adjusting entry, or to recognize depreciation for the period, or something like that. Our next entry up, employee salaries owed for 2 days of a 5-day work week. Weekly payroll is $20,000. What they're saying here is that our end of period includes 2 days of a 5-day work week that we're going to pay next period. So we have to recognize 2 days of payroll. So what we're going to see here is 2 days out of 5 times $20,000. So $8,000 of salary expense we're going to recognize. When we accrue salaries, it's always going to debit salary expense, credit salary payable. Again, I wouldn't worry about figuring out these journal entries on an exam. I would have my adjusting entries written on one section of my reference sheet, and then I could look up my salaries adjusting journal entry. And it's always going to look like this. The only thing that's at debate is how much. And you're saying how much of the salary related to this period. In this case, it was 2 days out of 5. So 2/5 of $20,000. Alternatively, we could have taken the $20,000, divide by 5 days, and our payroll is $4,000 a day. So we could have done $4,000 a day times 2 days and come up with the $8,000 as well. Now this next one, entry F, income before income tax, $21,000. Income tax rate is 35%. What we're doing here is we have to figure out, we have to accrue income tax. And we're going to accrue income tax because we owe income tax on this $21,000, but we're not going to pay it until taxes are due next period. So we, in the meantime, need to set up this liability and the expense. And how we'll do this is we'll take the $21,000 times 35% to get the amount of the tax. So what we'll see is $21,000 times 35% is $7,350. So we are going to debit income tax expense and credit income tax payable for the $7,350. And those are our adjusting entries for requirement 1. So requirement 1, we did those 6 adjusting entries. And now for requirement 2, we're going to do something else. They're saying, suppose we didn't make these adjusting entries. So requirement 2 is saying we didn't make these adjusting entries. What's wrong with income? How much is income overstated or understated if we didn't make these adjusting entries? So they're just saying, what if we didn't do it? What's the impact of not doing it? Well, first of all, if we omitted the revenue that we just accrued for, we would not have interest revenue, we would not have service revenue. So all I did here was I went through the 6 adjusting entries and picked out the 2 that related to revenue and said, if we didn't make these adjusting entries, we would have not had interest revenue of $2,600. We would not have had service revenue of $1,200. So we would have understated net income by $3,800 for the revenue. But we're not done yet. Those were 2 of the entries. The other 4 dealt with expense that we wouldn't have recognized. So net income would also have been overstated if we hadn't included insurance expense, depreciation expense, salary expense, and income tax expense, or a total of $23,450. I'm going to pause for a minute while you read that or write that down. So if we wouldn't have made those adjusting entries, we would have had net income understated by not including our revenues and overstated by not including the expenses. That's 2 opposite effects. So we're still not done answering this question, but we have the understatement of $3,800. We have the overstatement of $23,450. So you see where we get those. We're getting the impact on revenue and the impact on expense by going through the 6 adjusting entries that we had done above. So now, the $3,800 and the $23,450, we're going to see them on the next slide. So the overall effect is net income would have been overstated by $19,650. How I got that was I took the $23,450, the overstatement due to leaving those expenses off, subtracted out the understatement by leaving off the revenues of $3,800, and that's where I got the $19,650. And that's a really popular question for me to get via email about this exercise. So hopefully that helped you. Any questions? Anybody have any questions for me? It is rather early. Okay, I think I'm going to go forward here. Yep, okay. Just going to proceed. Now, it talks in the chapter about constructing the financial statements, and I just want to point out some of the exhibits in your book. Exhibit 310 gives us an income statement, and this really is a nice income statement. It gives us revenue, and again, these are Excel headings. A, B, C, D are Excel headings, and then the rows are 1 through 23 here. But it gives us revenues, and then gives us expenses, and we have income before tax, and then we subtract tax expense and get net income. Now the next statement we prepare after an income statement is a statement of retained earnings. And that the statement of retained earnings starts with our beginning retained earnings balance, adds our net income, subtracts dividends we've paid to give us our ending retained earning balance. So these are just exhibits 3-10 and 3-11 are just nice exhibits of those 2 financial statement formats. These are good ones to put on your reference sheet. They include a lot of things. Then exhibit 311 or 312 is a balance sheet. Now at the top they're replicating statement of retained earnings again. The ending retained earnings goes to the balance sheet in the stockholders equity section. But this exhibit 3-12 gives us a really nice balance sheet in that we have several assets. We see how accumulated depreciation, which is a contra asset, is shown on there. And then we have liabilities and equity. Again, liabilities plus our equity has to equal our total assets to be in balance. So those are just exhibits I wanted to point out to you as being nice, good examples of those statements. So exhibits 310, 311, and 312. Very good. So now what we're going to do is we're going to do another homework exercise, and this one's 3-13. This one's not a lot of writing. This one's more a conceptual exercise. This one, it says that Bowdoin golf company prepaid 3 years' rent on January 1st, 2014. Okay, so January 1st, 2014, the company paid 3 years of rent, and what we're going to do is, first thing off the bat, let's figure out how much rent we have per year then. That's going to be $36,000 divided by the 3 years, gives us $12,000 of rent expense per year. So that's just a computation I'm doing so that I have that off to the side as I'm going to be answering these questions. The first question says, this is saying at December 31st, 2014. So at this point, a year has gone by. Bowdoin prepared a trial balance and then made the necessary adjusting entry at the end of the year. So, and it tells us they adjust their accounts just once a year at December 31st. So the first requirement is what amount appears for prepaid rent on their unadjusted trial balance. So that's before they do any adjusting entry at all. Oops. Okay, I'm going to switch because this line is off. Okay, let me just, here we go. I think when I switched from a Windows to, let's see, and the rest of these look good. Okay, so let me just, okay, so exercise 313, what amount appears for prepaid rent on the company's unadjusted trial balance? So that's saying before they make any adjusting entry, what is in that asset called prepaid rent? And that will be the full amount, the $36,000. They haven't made any adjusting entry yet. This is before doing that. Now, entry B says, what about their adjusted trial balance? So after they make the adjusting entry, how much asset do they have left on December 31st? So that's saying how much rent's left after a year's gone by. Well, how much rent's left after a year's gone by is going to be $24,000 or 2 years. It's $12,000 per year. We haven't used 2 years yet, so 12,000 times 2. Or we can say we started with $36,000, 1 year's gone by, so we've used $12,000, we have $24,000 left. So the A and B focus on the balance sheet. What's in that asset? The unadjusted trial balance is before any adjusting entries. The adjusted trial balance is after we make the adjusting entry. Now, part C and D. Part C says, how much rent expense do we have before we make any adjusting entry? Well, the answer is 0, because we have not made the adjusting entry yet, so we don't have any rent expense. But after the adjusting entry, we would have $12,000 of rent expense. Okay, from that 1 year. So it makes a difference whether we're using an unadjusted trial balance or an adjusted trial balance. Unadjusted means we have not done the entries yet, the adjusting entries yet. Adjusted means the adjusting entry has gone through. So hopefully that one's not too bad. Once you walk through it, it seems pretty straightforward. Now we're going to do an exercise where we're walking through constructing financial statements. So we're actually going to do a few financial statements. We did some in some earlier chapters, very similar. So what we're going to do is we're going to prepare an income statement, a statement of retained earnings, and a balance sheet. And we're going to link all these statements together. So we're given a bunch of information. That information is not given to us in any order. So we don't need all the information for every statement. So this is short exercise 3-15. We're going to start with the single-step income statement. So let's get started. Single-step income statement. start with the top of the income statement like we've done every other statement we've done. It starts with the name of the company, followed by the name of the statement, and then the period ending. This is an income statement, so it's a period of time. So this is for the year ending July 31st, 2014. Those should be easy points when you take the exam if you have to do an income statement or any kind of statement. The name of the company, the name of the statement, and then the date line, which for an income statement is for a period ending. Okay, next up, we're going to have revenues. And it tells us this is in thousands. That's in the very beginning. That's the problem. So the first thing we do on an income statement is we list our net sales or net revenues. And that's given to us in the data table. It's $180,500. Next, we're going to subtract cost of goods sold. Cost of goods sold, if we have it, is always the first expense listed. Remember that cost of goods sold is an expense even if it doesn't have the word expense in it. And then we'll go through that list looking for other expenses. And we see all other expenses, $29,600. And then we can get our net income. And how we get our net income is we take our net revenues, subtract cost of goods sold, subtract all other expenses, gives us net income. And that's our single-step income statement. A single-step income statement is different from a multi-step in that it doesn't have any subtotals. And we'll see a multi-step at the end. I'll show you an exhibit in the book that includes that. So that's our net income. And I'm going to go to a new page just because I don't have room on this one. But that net income of $14,900 is going to follow us to the next exercise. To the next statement. So I'm going to go on here. The next statement, statement of retained earnings. So the statement of retained earnings, we're going to start with the statement headings just like we did before. The name of the company, the name of the statement, and the statement of retained earnings is also for a period. So this is for the year ended July 31st, 2014. On this statement, we start with the beginning retained earnings. And the beginning retained earnings is last year's ending retained earnings. So that's given to us in that table above. The very first number they gave us was $36,500. So that's our ending retained earnings from last year. It's our beginning retained earnings. And then to this, we're going to add the net income from the income statement that we just did. So that $14,900 that we just did, we get to add it here. We don't have any dividends because in the table, if you look above, the last item given in the far right column says dividends of 0. So we don't need to do that. So we can simply end our statement here. So we're going to take our beginning retained earnings, add our net income, end up with our ending retained earnings. Again, we don't have dividends. If we did, we would be subtracting dividends. And that's it for the statement of retained earnings. Now we linked the net income from the income statement down to this one, to the net income. And now this ending retained earnings figure that we got, the $51,400, we're going to see that on the balance sheet. So that would be linked to the next statement we do. Now the next requirement is to do the balance sheet and the classified balance sheet. Now I'm going to have to zero out or blank my screen because I don't have enough room to do the balance sheet and leave the data on the screen. So know that all the numbers I'm using are coming from that table and from this ending retained earnings balance on this statement that we just did, the statement of retained earnings. So let me go to the next one. Now we're going to do the balance sheet. So again, we start the balance sheet with the name of the company, the name of the statement, and the date. The balance sheet's the one statement that is as of one particular date and time. It's the balances. It's what we own and owe as of a certain date. So it's not a time period statement, but it's for one particular date. Okay? So then the balance sheet starts with assets. We always start the balance sheet with our current assets, and those are things that are going to be maturing, returning to cash within 1 year. Okay, so we're given cash, we're given accounts receivable, inventories, and other current assets. So our total current assets are $84,700. I'm giving you a minute to write this down to keep up with me. So what we've done here with the current assets is we're listing everything that's going to be cash within a year. We always start with cash because that's our most liquid asset, and we go from there. So we have cash, accounts receivable, inventories, and other current assets. So our total current assets are $84,700. Next up, we're going to list our other assets, longer-term assets. We have property and equipment. Given to us is $19,800. Again, these numbers are given to us in the table, and we see other assets listed for $22,000. Others usually at the end of the category. So then we add the $84,700, the $19,800, and the $22,000, and we end up with total assets of $136,500. We're done with half our balance sheet. Remember, the assets have to equal the liabilities plus the equity. So we know what the liabilities plus the equity are. They're $136,500. Now we're going to go on to the other half of the balance sheet. I'm going to have to leave this screen, so just because I'm out of screen real estate. So next up, we're going to do the liabilities. So we are still working on the balance sheet. This is continued. So now we're working our way down through liabilities. So liabilities, again, we do our current liabilities first, and they're listed for us as $55,100. Long-term liabilities are given to us as $7,500, giving us total liabilities of $62,600. We're not done. That's our liabilities. So now we go on to the equity section. Stockholders' equity is going to be common stock, which is given to us as $22,500. And next, we're going to add retained earnings. Now, this retained earnings, the $51,400, we just calculated that on the statement of retained earnings. So we have to calculate it. So that $51,400 we did on the last statement, and it would be linked to the last statement. That's why we have to do these statements in order, because they feed each other. So we add the common stock and retained earnings together, and we get total stockholders' equity of $73,900. And then we can add our total liabilities of $62,600 to the total stockholders' equity of $73,900, and we get $136,500. And that is exactly the total of our total assets, so we know that our balance sheet is in balance. And that does it for short exercise 3-15. Next on my agenda for today is I want to go through and talk more about closing entries. We didn't have a lot of class time on it. This is definitely a section you want to read in your book about it. So closing the books. Again, we had this slide on Wednesday. And when we close the books, this is at the end of the period where we would close our revenues, close our expenses, close our dividends. And what I'm going to do right now is I'm going to go through an example. So I have an illustration here. It's in the PowerPoint, so if you don't have the PowerPoints downloaded, you can grab the PowerPoints, but this whole example is in the PowerPoint. So we have a list of account balances from Westmont Services Corporation at December 31st. So here's all their balances that were given to, and they're in no particular order, nor do we need every balance. What we're going to do is we're going to do the 3 closing entries. We're going to do the revenues, the expenses, and the dividends with the same data. So what we're going to do first is we're going to close the revenue accounts up in the upper right-hand corner, where we have closed revenue accounts right there. Okay, that's what we're doing. So we're going to close those revenue accounts. Now, the revenue accounts are going to be any revenue that we identify, and when I go through here, I'm kind of looking for the word revenue. Service revenue is certainly a revenue, so I have service revenue right here, and then I have interest revenue. Now, when I said we're looking for the word revenue, remember that we don't want to find the account unearned service revenue because that's actually a liability. But we see 2 revenue accounts. So we are going to close those accounts. And when we say close, we say we want to make them 0. We want to wipe them out so they can start over fresh next year. So what we're going to do is we're going to debit the revenue accounts. And that's always going to be the way on a closing entry. We're going to debit each of our revenue accounts. So we're going to debit service revenue for $63,800. We're going to debit interest revenue for $800. Let's say we had miscellaneous revenue. We would debit miscellaneous revenue. Every single revenue account we have, we would debit. And then when we're done with revenue accounts, which we are, we would then credit retained earnings for $64,600. How we got that number is we added all the revenues that we debited together. So we added the $63,800 and the $800, and we got the $64,600. Now, closing entries are really super easy if you write them on your sheet. Closing entries. This is the revenue closing entry. Debit every revenue, add all those up, and that's how you get the credit to retained earnings. That's it. That's all you're doing. So a closing entry for revenue, very, very easy. Next up, we're going to do the closing entry for the expenses. Now, the closing entry for the expenses, so now we're looking at these expenses. We're closing our expense account. So now what we need to do is we need to identify every expense account. So we'll go through here. Okay, I've got one right here. I've got selling and administrative expenses. I have depreciation expense. That's another one. I have income tax expense. So I'm looking for all my expenses, and I have one more expense that we skipped. Do you know which one it is? It's one that doesn't have the word expense in it, but it's typically one of our biggest expenses, and it's the cost of goods sold, cost of services sold. Cost of goods sold, cost of services sold, that is an expense account as well. So in this case, we have 4 expense accounts. So what we're going to do for this is we are going to credit every expense account we have listed. So we'll credit cost of services sold for $28,600. We'll credit selling and general and administrative expenses for $12,800. We'll credit depreciation expense for $8,200, and we'll credit income tax expense for $1,200. How do I know they're credited? Because expenses have a normal debit balance, and to credit them, I will zero them out. I want them to be a balance of 0. So I need to credit all the expense accounts, and then I'm going to add all those together and debit retained earnings. So what we're going to see here is, see all those credits, the credit to cost of services sold, the credit to selling general administrative expense, the credit to depreciation expense, and the credit to income tax expense. So we have those 4 credits. I add those 4 numbers together, and that's where I get my debit to retained earnings. To close expense accounts, I am always going to credit every expense account I have, and then the total of that will be debited to retained earnings. So you really don't have to memorize this either, nor do you have to wrestle with it. If you're going to do a closing entry for expenses, you are going to credit every expense and debit retained earnings for the total. That's our closing entry for expense accounts. So we've done the closing entry for revenues, we've done the closing entry for expense accounts, and our only one left is to close dividends. So to close our dividend account, so again, we're looking at closing our dividend account. We have to identify our dividends, and they're given to us right here. We have dividends of $600. So how we close that is we're going to credit dividends and debit retained earnings. And that's always the way the dividend closing entry goes. We debit retained earnings, credit dividends. And now we have done the 3 closing entries. We're not done with this illustration, but those are the 3 closing entries. That's just like that, straightforward like that. Now, the next question for our illustration is, how much net income did Westmont Services earn during 2014? Well, our total revenues were given to us in the first closing entry. We had total revenues of $64,600. Okay, and that came from the $63,800 and the $800 interest revenue, but that was what we credited to retained earnings in the first closing entry. Then total expenses were $50,800. That was the total of our second closing entry, and that was their debit to retained earnings of $50,800. And then our net income is the difference between those two. So $64,600 of revenues minus our expenses of $50,800 gives us net income of $13,800. And then Finally, what we're going to do, notice that we don't subtract dividends here. Dividends are never used when calculating net income. But what we're going to do next is we're going to do the T account for retained earnings. Retained earnings, the T account, the first thing we're going to show in our T account is the beginning balance. This 5,200, that was given to us in the table, 5,200. So retained earnings has a normal credit balance, so we're going to have 5,200. Then we would have credited 64,600 to retained earnings in that first closing entry. You'll see a credit to retained earnings. Then we debited 50,800 to retained earnings in the second closing entry for expenses. And then we also debited retained earnings for 600 for the dividend in that adjusting entry. So if I take the 5,200 plus the 64,600 and subtract expenses of 50,800 and dividends of 600, we get an ending balance for retained earnings of 18,400. And it goes on the credit side because our credits are larger than our debits. And that's all there is to closing entries. Closing entries are not complicated, but you need to write it on a quarter of your sheet and have it there to be able to refer to. And when we talk about closing entries, just to summarize, closing entries, the purpose of them is to prepare the accounts for the next period. And we set revenues, expenses, and dividends to zeros. Those are our temporary accounts. A nice acronym is RED, revenues, expenses, and dividends. Okay, that's it on closing entries. What I've got left to do today is I did want to point out a couple more exhibits that have some good examples you can follow. Exhibit 3-14 gives us a classified balance sheet. When we talk about a classified balance sheet, it's breaking our assets down into current assets and long-term assets, and then it breaks our liabilities into current liabilities and long-term liabilities, and then stockholders' equity classified in various ways as well. So classified balance sheet, again, the A, B, C, D, E are column headings in Excel. So that's Exhibit 3-14. Exhibit 3-12 is another way to present a balance sheet, just side by side. Now, 310, we talked briefly, we had an exercise where we did a single-step income statement. And here is a single-step income statement. We list our revenues, we list our expenses, take the difference, and we get income before tax, then subtract our income tax expense, and we get net income. Okay, so single step, very, very straightforward. That's Exhibit 310. Then compare that to Exhibit 315, which is a multi-step format income statement. And multi-step just has a lot more subtotals. And the subtotals, we'd have net revenues, which is revenues minus cost of sales gives us gross profit. Then we deduct a bunch of operating expenses, and we get operating income. Then we subtract gain or add gains. And we do a lot of subtotals. So all multi-step is saying is we're going to have a lot of subtotals. And that's good for investors to use the information, but that's what's meant by multi-step format. I'm not sure that I would memorize this multi-step. I just wanted to point out when something says multi-step, it's looking for the statement with a lot of subtotals on it. And then what we're going to do to finish up today, at least in terms of content, is we're going to do a series of examples of the adjusting entries, because again, I think that's worth revisiting. So we have Freddie's Auto Service, and Freddie's Auto Service would like to make an adjusting entry to accrue income tax expense. So June 30th, the last day, they're going to accrue income tax expense. Let's say that $600 was given to us, and the adjusting entry for accruing income tax is to debit income tax expense and credit income tax payable. Okay, let's see. And I think that's the last adjusting entry that I want to do that we haven't already done. That would be it. Okay, so now what I want to do is I want to go back here, the beginning. Okay, and I want to open it up now for any questions anyone has about the exam. While you're typing your questions, if you have any, I do want to emphasize that you should do that practice exam that counts as a quiz. That's very good. You can do it unlimited times. That's very good practice. If you're worried about ruining your grade on the quiz, I can certainly understand that. It's a very small in the overall scheme of things, but if you're worried about that, there is a study plan button in My Accounting Lab that will get you to the same content that's on the practice exam. Study plan does not count for your grade at all, but it gives you a way to practice the same content that's on the practice exam. So, but the practice exam, very good. You should also have read the chapters, all 3 chapters, taken notes, take notes as we go through class. I think I've pointed out things that I would put on my reference sheet. And that practice exam, you've got to do, and do it over and over. And accounting is something that you really need to practice to be able to do. And so that's why I'm giving you the practice exam, and that you can take it as many times as you want. I would definitely be able to take it. And if you're taking it and you're only getting 50% on it, don't expect to do better on the real exam. Really, that should be, if you take it 3 or 4 times, that should be a reasonable approximation of your grade on the real exam, assuming that you're taking it pretending that you have real exam conditions, meaning that you're not using the Help Me Solve This, that you're using your note sheet. And that brings me to another point. When you make your note sheet, that's part of the learning process, is putting that together. But you should have your note sheet put together and then take the practice exam, because then you're going to see what you need on your note sheet. Maybe there's other things you need on your note sheet that will help you through the practice exam, and then the real exam. The practice exam is not timed. The real exam is 120 minutes. So just keep that in mind. You can keep your eye on the clock when you're doing it, but that practice exam should give you some more confidence, or it should be a trigger that you need to prepare more. So does anyone have any questions that I could answer about that? I sent out a couple emails this morning through Blackboard. I'm not seeing a lot of questions here. I'm not seeing any typing going on. I'm not getting off yet, but I think we're going to wrap up the recording. So just a minute. If you have questions, you can email me.